Good afternoon, good afternoon, good afternoon. Excuse me. Today is Saturday, February the 14th, 2026. It's been a while since I've created a video, mainly for health reasons. I had to step away for a while and things of that nature. So anyway, I wanted to come at you because I am currently trading, and I'm not one of these guys who says, well, real estate's better than the stock market is better than real estate, or this investment is better than that investment. It's all in your preference. Now, I've done both, done real estate, and I've also done the stock market. And my personal preference is I prefer the stock market. But I'm not going to tell you it's better. To me, it's just another vehicle. But I do have a preference. I'd be lying if I tell you I don't. Um, So here's why I prefer the stock market over real estate. Because let's say do real estate, I have to put up, like say, on my first rental property that I bought, my only rental property that I bought, I had to put down $7,000 to and get a mortgage of 100 grand in order to buy a rental property. Well, let's say I had the same $7,000. Well, what could I do in the stock market? Well, here, this stock, which is JEPQ. Now, JEPQ, I think that's how it's pronounced. This is an ETF. And this particular ETF gives you exposure to different companies. Here's some of the companies that it gives you exposure to. Um, it's basically a NASDAQ. It gives you exposure to the NASDAQ 100, which gives you exposure to companies like, let's say, Apple, Tesla, okay, Nvidia, um, and other type of technology companies. So instead of now buying shares of Apple, I can get exposure to Apple by just doing the JEPQ and Tesla. I can get exposure to those two particular companies in particular, okay, without necessarily having to own shares of the company. Oh, and unlike those companies, here JEPQ pays a monthly dividend. So you see where it shows you on this screen right here, 100. What this is saying is I bought 100 shares at $61 or $6,100, 6,000, because if you $61 and you multiply it by 100 gives you $6,100 that you had to spend out. But that's not what I spent. Because of the premiums that I collected, my average cost basis is really around this 57. So that's really how much, it's not how much you bought the item for, it's how much you're spending out of pocket. And what I like about the stock market is here, this is basically called like a covered, I can do what is called a covered call. I own 100 shares of JEPQ, okay? And I can basically rent out my stock. So think of it like a property. You buy a property, okay? You buy a property and you rent it out to bring in rental income. Well, each time you're renting it out and you're bringing in that rental income, you're not only getting what is called cash flow, positive cash flow, you also reducing the amount that you ultimately paid for the property. You get enough positive cash flow, You eventually may, and I'm talking about, like, let's say you own a property, and if you get enough positive cash flow, you can almost get the property almost for little to nothing once you get back all that cash that you put into the property. So it works the same way here on a stock. So this JEPQ, right? So I got an average cost basis of around 58, $57, all the premiums that I've collected. And if you click on activity, I'm going to click on activity, you'll see here JEPQ, though it says 61 dollars that I bought the, see right here 61, but because I got $1.70 credit, you subtract the 170 from 61, so that tells you what my cost basis is. So my cost basis is around here. Now, what I'm going to do on Monday, not Monday because the market's closed on Monday. So on Tuesday, I'm going to sell a call option, which means I'm going to give someone the right to buy JEPQ away from me, to purchase JEPQ from me. But I'm really hoping that they don't purchase it. But, and I'm going to do it like around this $59. Now you see where it says 25 to 35. So I can, if I sell, I can collect 25. If I buy, I got to pay 35 cents. But if you multiply that by 100, that's really $25 and $35. So here I'm going to probably get around $30 if I sell it. Like, let's say on Tuesday, these premiums will be around $30. So I get an extra $30, which is not a lot of money. $30 is like what? Not even a night out, really. But you can order something for $30, whatever. Okay. And so, which gives the person the right to buy the shares away from me if it jumps above 59. And right now, if you look at the stock, it's right now trading, or the ETF, it's really trading at 57.50. That's the current price. So I'm going to give someone the right to to buy the stock away from me at 59. And so what that will also do is reduce my cost basis even further. So the goal is for the stock to go above what I ultimately paid for it. And eventually, like I said, and and this contract will be good for 34 days. These are called options, by the way. And the contract will be good for 34 days. Okay. And so in that time, I'm looking to also get a dividend, and a dividend is not another cash flow. So that would also lower my cost basis even further. So that's what I'm basically hoping to do with this particular company. Now you'll see if I click on positions, positions tells you what positions I currently am holding. Applied materials, APLD, BITX, BITX. Okay, this is a Bitcoin. They basically deal in Bitcoin. And so they also pay a monthly dividend. So you'll see here where it says that I bought the shares at around 28. No, that's the current trading price. Yeah, 28.33 when it says when I bought the shares, or 2,833. But that's technically not what I paid for it. I paid less. So I'm around that $26. So, but I'm still a little underwater of about $1,100. But that's okay because again, I'm holding the shares. I'm going to be selling, weekly covered calls. See, so if I click on BitX, okay, so I sold covered call, and it expired yesterday, an $18 covered call. The stock is at 15.87, so therefore that call expired worthless, and so I made some money off of that. So if I click on trade, here's what I'm going to do. Come Tuesday, See, and what I like about BitX is it has weeklies. So here for BitX, even though I'm underwater because again, if you look at this ruler and you see this is where they say the current price is at around here 1587. So this is called at the money. But if you look here, this is where they said that I own the shares at around here. That's how much I paid for the shares. But I really didn't pay that much. That's how much I bought. I mean, that's where I bought the shares at, but I didn't, but I own it for less. I own it for around here. But I'm not going to be able to collect nothing here. So what I'm going to do is sell a call option, which is below my cost basis. Now, usually, if you listen to most people, they would not recommend you do this because they say you're locking a loss. Well, you're locking a loss if you don't do anything. So if this stock or this ETF, should I say, because this is another ETF, if this goes up past 1750, I got to do something because I don't want to lock in a loss. So I'm going to buy back the contract that I wrote, the agreement that I wrote, and sell another contract. That's what I plan on doing come Tuesday. Okay? Because I'm not looking to lock in a loss. I'm looking to own the shares of this and let the stock go up. But in the meantime, collect premium to reduce my cost basis. And let's say I want to buy another 100 shares. Well, what I'm also might do is sell also a put at 1450, which would bring in another $42 or so. Now that will lower my buying power of about 1400, no 1377, but I lower my cost basis by another $73. Not $73, I'm sorry, 73 cents. Or I'll collect $73, but I'm lowering my cost basis by another 73 cents. And so that's the goal, is just to keep lowering that cost basis, wait until it pays me the dividend, which will lower my cost basis even further. And eventually, unless you think Bitcoin is going to go out of business, this ETF will be around, which means eventually I will be profitable in this company on this ETF, unless you think BitX is going to go out of business. Not BitX, I'm sorry, Bitcoins. Now, I own a position in Costco. Right now, that's profitable. Okay, and I'm making money so far on the year on Costco, and I just really started doing this since late last month, so it has not even been quite a month yet. Okay, DraftKings. Right now, I'm gonna put in a position where I may have to buy 100 shares of DraftKings, but that's okay. I would just keep rolling out that position. Google. Okay, I have contracts in Google. Hog is Harley Davidson. iBit is another Bitcoin ETF. Okay. INTC, that's Intel. I own 100 shares of Intel. Okay. So if I go 6 days out, see, again, I like collecting weeklies because I like to get paid on a weekly basis. It's saying here that I bought the shares at 53, but again, I didn't buy the shares at 53. I own it for a lot less. I own it for less. So here, but the premiums are a little better. So for Intel, I might sell the 49.50s and collect 48 cents, $48. Matter of fact, just so you know, yesterday I collected a total of about $500 yesterday in premiums. So you see here where it says the profit PL year to date is a negative 424. The market went down the other day. And so I'm not really worried so much about the fluctuations of the market. I'm collecting enough premiums that eventually that goes away. It's about, getting the cash flow. So everything I'm doing is in a selling position here. Just all of these here, I brought in some form of cash flow. But I'm doing different strategies also. TQQQ, that's the Nasdaq. The T triple Qs. This is a leverage ETF. It's I think a 3x, a three times leverage ETF. So that means if the QQQ goes up 1%, the TQQ theoretically is supposed to go up 3%. But the downside is also true. If the QQQ goes down 1%, then the TQQQ goes down 3%. So depending how the market performs, and I'm talking about the QQQs, TQQ could either overperform or underperform the market. But again, um, I got trades on all of these. So when you think about it, matter of fact, if you look here at the trading price tells you how much I basically have collected for the most part on these particular trades. Actually, the cost, I'm sorry. The cost is basically what I've collected. Yeah, because notice it matches up with the trading price. The cost is basically what I basically collected on these trades, or in this case, paid. Allegedly, I paid because I bought the shares, for 5,300 or $53, paying 5,300. But I technically didn't pay that amount. I paid less, but it doesn't take into account the premiums that I've collected. So I'm in better shape than what's being shown here. So what is my plan for this Tuesday? Because Monday's market is closed. Notice here it says 1750. I think that means I made like $17.50 today because even though the market is closed, certain stocks or ETF, certain positions, excuse me, should I say, excuse me, apologies, certain positions, should I say, is still ongoing. So I got 14,000 buying power remaining, or I can buy 29, almost $30,000 worth of stock I can buy. This is saying. So on Tuesday, I plan on doing like going with the SPX. Now the SPX is the S&P 500, Nasdaq. I mean not Nasdaq, the S&P 500. So these are the 500 largest companies in the US. Now, if the QQQ, the DIA, which is the Dow 30, or the SPX or SPY, because the SPY is the ETF of the SPX of the S&P 500. If those go to zero, then the world is coming to an end, literally and figuratively. So these are not going to zero. But the market can go up on Tuesday, or the market can go down on Tuesday. So what I like about Tasty Trade is I'm going to click on this 3-day. Okay. Now, you see over here, it shows you a 67.98. So what this is saying is the options market or the market makers, because that's what they're called, market makers, is anticipating. And most of the time, it doesn't reach this amount, but sometimes it does. But 68% of the time, it doesn't. Okay, because these are all about probabilities. So what they're saying is that the market may move up $68 $67.98, so I'm going to round it up to 68. Or the market may move down $68. You don't know which way the market's going to move up or down. But there's a better way, in my opinion, to find out what the actual move may actually, not the actual move, but to anticipate what the expected move is going to be. And that is you buy the at the money call. This is the call side, and you buy the at the money put. So here it's saying it's 70. So I'd rather use this number. So, and so now what this is telling you is this is like a one standard deviation. And again, the market tends to move. You have what is called one standard deviation and two standard deviations. Two standard deviations, the market tends to stay under that two standard deviation 98% of the time, some astronomical number like that. But under one standard deviation is 68% of the time. Okay, so if this say is 70, 50, $70.15, you multiply that by two, so that's like $140. So that's two standard deviations, $140 away. So what I'm going to do is take $140 and add it and subtract it from this current price of 68.36. So let me see. I'm going to use my phone calculator, by the way, real quick. $68.36. .17. I'm going to say minus 140, let's say 45, equals 66.87. So 66.87. So this is going to be going down 66.87, which is around that 10 delta, because it's 66.85. So what I'm going to do is I'm going to go, and these lines here tells you the standard deviation. So this is two standard deviation. This is one standard deviation. So remember, the market tends to stay below the two standard deviations like 90 something percent of the time. So I want to go below this two standard. So I'm going to go to the 8 delta, because there's an old saying in the trading market, on the stock market: bulls go up the stairs, bears go out the window. Now, which one moves faster? Something that goes up or something that falls down? Which one moves faster? Obviously, something that falls down. So I'm more concerned about the downside of the market than the upside. So this is two standard deviation. And look, I could get decent premiums here if I go even past the two standard. So I'm going to go to the 6660. Now, this is a 7 delta, which means there is a 93% chance that the market is going to stay above 6660, will not get to 6660 by Tuesday. That's all that means. That's all that means. There's a 97% chance the market will not get to 6660 by Tuesday. Will not touch 6660 by Tuesday. I'm going to go 10 points wide. Okay. And see here, it says 40 cents. I'm going to collect 40 cents times 100, which is one contract. So that's $40. So look, I get $40 on the downside. So, oh, I don't want to do no 9-day, excuse me. No 11-day. No 10-day. Ay, senor. I'm doing 3-day. So now I'm going to do, come on, keep doing that. Matter of fact, let me minimize this so this doesn't. So I'm going to add about the same amount on the call side. So 68, 32, 17 plus 145. 68, 36.17 plus 144 equals 69.81. Well, 69.81 is around here, but I'm only going to collect around 10 cents, 10, 15 cents. So I'm going to go a little higher. Well, I don't want that. I'll just delete that in a second. Matter of fact, let me just move this up. I'm trying to move this up, and this thing is not cooperating. Oh boy, this is the problem with doing this on the computer is that sometimes the computer don't act right. I'm trying to move this call up. Let me do it to see here. No, I'm trying to move this up. Eventually I'll get there. Just give me a minute. Be patient. I don't know why my computer is so sensitive. Just trying to move it up about 4 more strikes. Delete leg. Just do it this way, Jermaine. I'll do it here and then 10 points wide. Here. Perfect. I should just did that from the jump. Okay. So here I'm risking $900 to make $100. Now you say, Jermaine, why would you risk $900 to only make $100? Here's why. See this POP? That's the probability of profit. That means I got an 88% chance of making at least 1 cent or $1. In other words, making something by Tuesday's expiration. That's why. This is all probabilities. And remember, only one side, this is called an iron condor, by the way. Only one side can be in trouble. Either the put side is in trouble or the call side is in trouble. Matter of fact, what if I do this on a curve? Change this from a table to a curve. See, This is where the stock or the index is currently at. See, this is the put side. This is the call side. Notice I'm giving myself more room to the downside because why? A index or a stock falls faster than it goes up. So, but I'm still giving myself room to the upside. So I think I'm going to do something like this on Tuesday. Collect a dollar. If you multiply it by 100, that's $100. So I can make $100 in a day. And how many people can make $100 in a day doing in less than 10 minutes worth of work? Just think of it. Just think of it that way. Just think of it that way. How many people can make $100 in doing 10 minutes, 15 minutes worth of work and make $100 in a day? And I will most likely be able to keep that, even though the goal isn't necessarily to keep the full 100. If I can get half of that in, like, say, an hour or two, which is like $50, I'll take the win and go home. Because I'm still making $50 in, like, say, an hour or two. If it's an hour, it's $50 an hour. If it's 2 hours, it's $50. That's $25 an hour. But you get the point. Okay. And again, I got an 88% chance of making at least something. That's all this is saying. And again, this is all probabilities. So this is like what the casino does. How you think that they say the house always wins? Because the house becomes the casino. So the house is doing all they doing when they placing these bets is they're doing probabilities. What's the probability that the house wins? What's the probability that the gambler wins? Well, if the house wins 88% of the time, and remember, the percentage is from 0 to 100. So let's say if you subtract 100 from 88, that means the person who buys this option only going to win 12% of the time. And remember, for every buyer, there's a seller, and for every seller, there's a buyer. In the markets, that's just basically how it works, especially when we're dealing with bid ask spreads. So come Tuesday, I might look to put on this type of trade and make me a nice little income. Now that $100 can go away to help paying a bill or two. So even if I'm not working, this is a way to help pay my bills. So this is how I can pay my bills when I'm not working. And this is a conservative trade because again, I'm going far out, but as I can to make decent premium and yet being safe. Now you say, okay, what happens if you start to lose? So let's say this is going more towards the upside because the upside is closer, right? So then what I would do is I would adjust, I would buy back this spread here, move it out for a loss. It will take a loss, but make up the loss by moving up the puts to collect more than what I'm losing on the call here. So that's a way of managing this if the stock gets out of hand. And it took me a while to figure out how to do this. I mean, ultimately, I took a course on this. Um, so I want to be thankful to the Dorian way because they taught me this. Options Animal is also good. Those are some courses. There are some courses that I would recommend, but some courses are much more expensive than others. Um, but what I like about the Dorian way is that the person who heads up the company looks a lot like me, if you get what I'm saying. So that's why, I have a special affinity for the Dorian way. Um, so that's what I plan on doing on Tuesday. And I will walk you through a live trade on Tuesday when the market is open. I'm going to actually walk through the trade and show you not only the entry, but the outcome of the trade. What happens at the end of the trade? So I'm going to show you all of that. And, so I want to thank you for watching another segment of the Jermaine Brown Trading Show. Because again, the markets is closed, so there's not much I can do right now. So I can't wait for the new week to start because there's money to be made in these markets. And it's my job to extract some of that money. I will talk to you guys later.